So this lesson is an extension of the market structure lesson. That was the first lesson in this part of the module. And in that lesson, we talked about basic Dow theory. So the chart that's on the screen, higher highs and higher lows, the characteristics of an uptrend. Lower highs and lower lows are characteristic of a downtrend. We then took that further, talked about Wyckoff and all different combinations and breakdowns and ways that you can trade it. But now we're going to revisit the structure so that we can see what to do when structure breaks, which is also known as a trend shift. So you've seen this schematic, let's take it a little further. Again, I want to reiterate that we keep things simple here. So there are two main labels that you need. To denote trends as they continue, each time the low gets broken in a downtrend or each time the high gets broken in an uptrend, it's called a break of structure. And you can mark that as BOS. So BOS equals trend continuation. Remember that. A reversal, on the other hand, or when the trend shifts, it always begins with what's called a market structure break, a change of character, or a trend shift. Trend reversal. You can use any of those that you wish. Pick whichever one works for you. I personally use market structure break, MSB, but you can do whatever you want. The only point of it is so that you can differentiate between trend continuation and trend reversal. So the reversal always begins with a market structure break or change of character. The reason some people call it a change of character is because the characteristics of the previous move have changed. Meaning, the previous pattern of lower lows and lower highs, or higher highs and higher lows, has changed. And the break of structure, as well as the MSB, or change of character, is always measured using candle closes. If you don't wait for candle close confirmation, it is not a valid break of structure, it is not a valid market structure break or change of character, and it's possible that the move is just a sweep of liquidity and not truly the continuation or shift that you're looking for. So with that out of the way, let's look a little deeper into it. So this, from a real chart, is a line chart. For anyone who doesn't know, you can have line charts or candlestick charts using whatever charting software you want. And a line chart measures price based only on candle closes. So the line will not move until there's a candle close, and then we go on to the next time period. It ignores wicks. And in a second, I'm going to show you this exact same chart, but with candlesticks, with the candle bodies, the candle wicks, so you can see the difference and see why it's important to use both. I want you to watch the blue line in particular when we move to the next slide to show you how important it is to focus on the closes. So much like the schematic I showed you a second ago, you have highs in your uptrend, and when they break, it's called a break of structure. That denotes continuation. Break of structure, continuation. Break of structure, continuation. Break of structure, and then eventually, when price trades back down through the preceding swing low, it's a market structure break or change of character, and that shifts us into a downtrend. Now, let's view the same chart, but with candlesticks. You probably immediately think that this has just got a lot more messy. And so, this should serve as a reminder to always keep in mind your line charts. If this looks cleaner to you, if this makes more sense to you, if you could just watch this and say, well, actually, when price came all the way down here and then bounced up into there, I could have conceptually got short much easier because I can see a very clear break. I can see a very clear change of character from what it was doing before, and that makes sense to me. And viewing it with candlesticks, which is the way most of you are currently viewing it, and it's the way most traders view it, might actually introduce more noise than signal, meaning it might be more confusing than it is helpful. But the part I wanted you to look at was the blue line. So of course we have our breaks of structure, which, when you view it with wicks and candle bodies, it's important to note that the break of structure is not when this high gets taken, it's when the candle close gets closed through by another candle. That's a break of structure. You then set your structure line level, your highest high, on the candle close, and when that breaks, it's a break of structure. So these together form what becomes this on the line chart. Now, on the way up, of course, you want to mark your lows because they denote your market structure level. They denote your swing lows, which we'll talk about in a second. And so you're marking these lows, you're marking this low, you're marking this one, which is the one I want to highlight. So this was the low, the candle close of the lowest low before the next break of structure. On the candlestick chart, we come down, and if you see closely here, the wick of this candle actually goes below the structure level. But you'll note that I say this is not a market structure break, this is not a change of character, and this does not indicate a reversal, because wicks are to be ignored on these moves. And an easy way for me to drive that point home is to go back here and show you how it looked on a line chart. Structure remained intact, nothing changed, uptrend continued. All right. So have both. Use both. They're both there for you. They're very simple to toggle between. You can have both open at the same time. There's no reason why you shouldn't whenever you're learning market structure. Now, after a while, you will be able to do it just off your candlestick charts. And after that time, it's important to view it on candlesticks because you're trading in an asset and in a class in crypto that has a lot of long wicks. You can't ignore the wicks because they denote other things like liquidity grabs, stop hunts, and things of that nature. So you need to be aware of the wicks. You can't just trade using the line chart forever. And eventually, you'll be able to just use the candlesticks. You'll know where the structure is and it'll be fine. But to begin with, have them both open. Now, let's talk about swings. This is a very misunderstood part of market structure. And this is the part that probably will have the most impact on you as a trader. So really listen up. We're about to get into the good stuff. First, let me define what a swing is. Sometimes you're going to see multiple highs or lows in a wave. And I'll tell you to focus on the swing low or the swing high as your confirmation of the market structure level. What does that mean? A swing is the entire wave in between two breaks of structure. So everything from this previous high all the way until the break of structure, this entire box, everything inside this box is a swing. Same is this swing from the high until the high breaks, from the high until the high breaks, from the high until the high breaks. These are the swings, all the shit that goes on in between, the consolidation, the chop, whatever you want to call it. All of that in between is the swing. Why is that important? Because you have to identify the swing low in an uptrend or the swing high in a downtrend in order to properly gauge whenever the market structure has shifted, right? So the swing is the entire wave in between two breaks of structure. The swing low or the swing high is always the lowest low or the highest high after the previous break of structure. We can call these other highs and other lows that are not within it interim lows. Okay, so bear with me. I'll go back between these a little bit. You have your swing low and you have your interim low in this uptrend. What does that mean? It means that you might have noticed in, for example, this swing low, we have a low, but we also have this other low right before the breakout. So you might say, which one of these is my market structure level? And similarly here, we have this swing low, which is where the red line is, which is where the market structure break occurs. But you might have said, we also have this low, which is right before the last pump. So why is this not my market structure level? That is why I say to focus on the swing low. So everything inside the box, the lowest point of that. Everything inside your box, the lowest point of that is your swing low. The other ones are interim lows. So there you have it. And the way to view this and trade this is to look back. If it seems confusing, don't worry. It will come to you with time. You don't have to guess these ahead of time. You look backwards. So every time there's a break of structure, I want you to go back and look at the entire swing before it, mark your swing lower high, and mark your interim lower high. Meaning that if you were here on the chart, when this breaks and it closes up here and it confirms a break of structure, you then go back and you say, okay, this was my interim low right before the break, but this was my swing low, which was the lowest low after the previous high. You had a high, you went down as far as here, and then you went all the way up to here. That's your swing low. Your interim low is important, but your swing low is the only thing that can cause what we're really looking for, which is the market structure break or the change of character. Very important. Interim breaks can give you early signs of a reversal, but the swing itself must break in order to be valid. It is a swing low or a swing high which causes what we call the market structure break or the change of character. All right? Mark your swings, have the lows. Mark your swings, have the lows. You'll notice that in these ones, at the beginning of this trend, it's a bit cleaner because the swing low itself is our lowest low before the breakout. The swing low itself is the lowest low before the breakout. So in times like that, it's nice and clean, it's nice and easy. But the market isn't always clean, it isn't always easy. So sometimes your swing low will be your ultimate low. Sometimes your swing low will have another low in front of it, like one of these. So you need to understand what both are, but you have to put priority on the swing low, which is why I'm emphasizing it so much. If you go back and look at the candlestick version of that for now, on candlesticks that will look like you have your down candle, which is your swing low, because if you look at this and imagine from the high of this break of structure here all the way around, see it as a swing, as it consolidates, dips down and then goes up. But right before the pump, we do have another red candle, a down candle. That is your interim low, because it's occurring within the swing. You still have your main structure level at the swing low. So, swing lows, swing highs, very important. A key part of market structure, especially when you get to lower time frames, because you're going to have many mini breaks, essentially impulse, interim lows and interim highs breaking. But it's only when the swing, the entire wave between two breaks of structure, it's only when that breaks that you consider the trend to be shifted. Everything else is noise. And often, just like in this one, it's not going to break just by a little bit. It will often give you a pretty big clear sign. Look at this, like a really clear break. There was no ambiguity with this. This was very obvious. And look, it came back up for a retest. Clear breakdown, nice retest. So you don't have to rush. You don't have to FOMO in. There's lots of time. You can wait for confirmation. Don't allow the market to dictate your emotions. So we've marked our interim lows, our swing lows, and we've reinforced that only a swing low or a swing high break can cause the market structure break or the change of character. Very, very important. Finally, there is a rule. Every trend shift begins with a market structure break or a change of character, but not every market structure break or change of character is a trend shift. Remember that we deal in probabilities, not certainty. Meaning, sometimes this will happen. The markets are not perfect. If it was that easy, everyone would be rich. So in this instance, a valid swing low breaks, but instead of failing and going lower, the market goes higher. This happens, and it happens quite often. This is what you might look at as a liquidity sweep, a stop hunt. The market dips down and traps people before going higher. So you can have failed market structure breaks, you can have failed change of characters, but every single trend shift will begin with a market structure break or a change of character. Every trend shift will have to have one, because you cannot shift trend without that happening. But not every time that you see one will it result in a trend shift. So think on that. I want you to think deeply on that. It's very important. What that will help you, if you internalize that and you understand that, that will help you to not get upset when, inevitably, if you're a market structure trader, inevitably, your market structure break, your change of character will fail. The point is not to be 100%. The point is to get as high a percentage as possible below 100% so you can retain profitability. This is particularly important because on lower time frames, meaning like a 1 minute chart, 5 minute chart, 15-minute chart, there are many more of these failed breaks than there are on the higher time frames. These occurrences are actually quite rare on a 4-hour, 1 day, 1 week chart. And that is simply because on a low time frame, it is easier for the smart money to push price into areas that show fake strength, or in this case, fake weakness, take the stops of day traders, and then reverse. Think of it that way. How hard is it to move price below 3 daily candles? Well, you have to go through 3 daily candles, 72 hours worth of price action, billions and billions of dollars of volume, just to get to wherever you want to go. But if you're looking at a 5-minute chart or a 1-minute chart, you've only got a fraction of the price action to go through, hundreds of thousands or millions of volume, which for the smart money, for the big players, is not hard to manipulate, not hard to move at all. And so there are many more fake outs, many more false breaks, many more stop hunts, much more, air quotes, manipulation on those lower time frames for that reason. They're trying to trap people by showing fake weakness or fake strength in order to gather liquidity and push price the other way. So that's it. That's an introduction to the concept of trading, breaks of structure for continuation, and then a market structure break, a trend shift, or a change of character for trend reversal. That is all you need to know to apply market structure successfully and correctly to whatever time frame you want to trade it in the only 2 ways it can go, which are continuing a trend or ending a trend.